Yesterday, something interesting happened in gold. US inflation data, or CPI, came in at 3.4% over year, exactly around expectation. Gold initially reacted positively and moved towards the 4,450 area. But then something confusing happened. Gold pulled back. Here is the question. If lower inflation is supposed to be good for gold, why did gold stop going up? And more importantly, how should a beginner understand this kind of market reaction? In this video, I am going to explain the fundamental story behind gold's move, and then at the end, I will connect it with technical analysis. No complicated economics, let's break it down. First, let's look at the CPI numbers. The July US CPI report showed 3.4% year over year, and core CPI came in around 2.5% year over year. The important thing is that these numbers were broadly in line with expectations. Now, if you are a beginner, you might think inflation is cooling, great, gold should go up. And initially, that's pretty much what happened. Gold moved higher and approached the 4,450 area, reaching a roughly 2-month high. But here is where trading becomes interesting. The market doesn't simply look at and then decide. There are several steps in between, and understanding these steps is the real lesson. Let's build a very simple chain. This is the connection I want beginners to understand. CPI is important, but CPI is not the final destination. The market is asking, what does this inflation number mean for the Federal Reserve? That's the real question. Let's imagine inflation comes in softer than expected. For example, market expects 3.5%, actual 3.4%. That can make traders think maybe inflation isn't getting worse, and that can reduce expectations for tighter monetary policy. If traders expect a less restrictive Fed, treasury yields can come under pressure and the US dollar can weaken, and that can create a supportive environment for gold. So the simplified chain becomes that's why gold initially reacted positively. Now comes the important part. The CPI number was not a huge surprise. It was basically in line with expectations. And this teaches us one of the most important lessons in trading. The market doesn't trade the number. The market trades the surprise and the change in expectations. Think about it like this. Suppose everyone expect you to score 80 marks. You score 80. Is everyone shocked? No. But if everyone expects 80 and you score 95, now there is a surprise. Financial markets work in a similar way. The number itself matters, but the difference between expected and the actual can matter even more. Now we get to the question that probably brought you to this video. Gold moved towards 4,450 level, then pulled back. Why? Because markets continuously reassess expectations. The initial CPI reaction supported gold, but traders then had to look at the broader picture. What happened to Fed expectation? What happened to treasury yields? What happened to US dollar? What happened with geopolitical risk? And these factors don't always point in exactly the same direction. Recent market commentary has also highlighted US Iran tensions and dollar strength as factors in gold's current price environment. So, gold isn't controlled by CPI alone. Here is another concept I want beginners to remember. Gold has multiple major drivers. These factors all support gold. That's when the move can become very strong, but sometimes they fight each other. For example, geopolitical tension can increase safe haven demand for gold, but geopolitical tension can also push oil prices higher. Higher oil prices can create inflation concerns, and higher inflation concerns can make traders expect interest rates to stay higher. So you can have geopolitical risk is bullish for gold, but at the same time, higher oil puts inflation. Higher oil, rise in oil prices puts inflation risks higher, result in Fed rate expectations higher, puts pressure ultimately on gold. That's why the market can look confusing. Now we understand that fundamental picture behind gold and concluded that fundamentally gold is bullish. Let's move on to the technical chart. I'm going to keep this very simple. We are going to analyze gold from 3 time frames. First to daily, then 4-hour chart. After we analyze 1-hour chart. This helps us understand the bigger trend first and then move down to levels where traders may actually be interested. Let's start with the daily chart. This is gold daily chart. Here I am going to switch from normal candlestick chart to Heikenhashi chart. Why? Because Heikenhashi can help us reduce some of the short-term price noise and make the overall trend easier to visualize. It doesn't change the actual market structure or price levels. So I am using it here mainly to make the trend easier to see. Now look at the gold's previous price action. Gold made an all-time high around the 5600 level. But after that high, the market started moving lower. You can clearly identify lower low followed by lower high and again lower low. This is a classic bearish market structure. So, for a long period, the daily chart was telling us gold is in a bearish trend. But now something interesting has happened. Let's focus on the most recent major swing high. That swing high is around the 4380 level. Now look carefully. Price came back up, tested this area, and then broke above the 4380 swing high. More importantly, we can see a Heikenhashi candle closing above this previous swing high area. And this is important because we are no longer looking at just a random bullish candle. We are looking at a potential change in market structure. In simple terms, we can say the market was making lower highs, lower lows. But now price has broken a previous important lower high area that can indicate a potential change of character or an early sign that the bearish trend is losing control. So on daily time frame, I would say gold is potentially transitioning from bearish to bullish. But remember, a single breakout doesn't guarantee a new long-term uptrend. We still need confirmation from the lower time frames, and most importantly, we need to see whether important support levels hold. And that's exactly why we are moving to the H4 chart. Now let's move to the 4-hour chart, and here is the picture becomes much clearer. Look at the structure. We are seeing higher highs and higher lows. That's a bullish market structure. So while the daily chart is showing us a potential transition, the H4 chart is already giving us a much cleaner bullish structure. Now let's identify the most recent important swing low. That area is around 4223 level. This level is very important for our bullish thesis. Why? Because as long as price continues to hold above this important swing low, the 4-hour chart, the H4 bullish structure remains intact. Think about it this way. If price continues to make higher highs, higher lows, and then higher highs, higher lows, buyers are still controlling the structure. But if price eventually breaks below that important H4 swing low, then we have to reconsider the bullish view. So right now, 4-hour chart is bullish. And our key question is, does price continue to hold above the important swing low? At the moment, the structure has not been broken. Now let's move down to the 1-hour chart. This is where I wanted to identify potential support zones. And here is an important rule. If market is in an uptrend, I'm not immediately looking for resistance and short trades. I'm primarily interested in where can buyers potentially steps in. Looking at 1-hour chart, we can see a strong bullish move. Price has been creating higher highs and higher lows. So again, the short-term structure is bullish. Now let's mark our first important support zone. The first support zone is located at 4310 to 4350 level. This is an area I am watching because of the previous price action and structure. If price pulls back into this zone and the bullish structure remains intact, we can watch for a potential reaction. But remember, a support zone is not a guarantee that price will bounce. We wanted to see confirmation first. Let's look at the second support zone, which is located at H4 swing low, 4230 to 4270 level. The second zone is more important from the higher time frame structure. So our technical bias is bullish. But there is one important thing. Gold is currently pulling back, and a pullback doesn't automatically mean the trend has reversed. Sometimes markets simply need to take a breath. After a strong bullish move, some traders may take profits. That creates a temporary decline in price. So, right now, I would describe the current move as potential profit taking rather than calling it as a major bearish reversal. What would change my view? This is probably the most important part of the analysis. I don't want to say gold is definitely going up. Instead, let's define what would make me change my bullish view. If price pulls back and holds the 4310 to 4350 support zone and bullish structure remains intact, then the bullish scenario remains valid. But if price breaks that area, I don't immediately panic. I would look at the next major support located at 4232 to 4270 level. That's where the H4 chart becomes much more important. If price eventually breaks below the major H4 swing low around at 4223 level, then the bullish structure would be seriously weakened. At that point, I would reassess the entire bullish thesis. So let's put everything together. From a fundamental perspective, we are currently bullish on gold, with the market closely watching inflation, Fed expectations, and the US dollar yields and geopolitical developments. And from a technical perspective, we are also bullish. The daily chart is showing a potential change from bearish to bullish. 4 chart is making higher highs and higher lows. And the 1 hour chart is also in bullish structure with our key support zones at 4310 to 4350 level. And the second one is 4230 to 4270 level. Right now, fundamentally bullish, technically bullish. If you like this analysis, please like and subscribe and turn on notifications. Thank you.